variety of different accounting terms and concepts and assumptions. So let's go through several of them now that kind of build a basic or a framework, a starting point for us to know before we get into some more specifics in different areas of accounting. So start off with, first one we've got here is GAAP, an acronym. GAAP, GAAP. This stands for Generally Accepted Accounting Principles. I like to refer to these as the rules of accounting. Okay, this is how we in the U.S. Go by or know what to do when we use accounting. How do we do things? What do we do? How do we record this? What value do we record this at? This is, again, our rules of accounting, how we know what to do things, how to do them, and what kind of authoritative regulations we should follow. That's GAAP, Generally Accepted Accounting Principles. The FASB, another acronym, we love our letters, okay? The FASB, Financial Accounting Standards Board, is the U.S. standard setter for accounting regulations. The IASB is the International Accounting Standards Board, and so they're the board that sets standards for the international scope. Now, the FASB and the IASB are still trying to work things out between the U.S. and, again, trying to make this a global scheme so that every country follows the same standards and the same rules and guidelines and regulations, so that you could look at someone's financial statements from, say, Italy, and they look the same, or they're done in the same way as one that's done in the U.S. So that provides us with good comparability and some other issues that we're going to talk about in just a minute. IASB, again, and FASB are still trying to work some things out. We are not totally on international standards here in the U.S. yet. But IASB has standards called IFRS, which are International Financial Reporting Standards. So those are the issues or the standards that the IASB issues, their rules and regulations for international standards. The SEC stands for the Securities and Exchange Commission, and this is a U.S. governmental agency, and they're the ones that have authority over publicly traded companies and look out over our financial markets and set standards for any companies that fall into those areas. So if you're a publicly traded company, you also have to follow some rules that the SEC sets. We also have the PCAOB. I told you we love the letters, okay? We're about to get out of the letters to real words, but PCAOB stands for Public Company Accounting Oversight Board. I'll give you that one again because that was a lot. Public Company Accounting Oversight Board. This was created out of SOX, so the Sarbanes-Oxley Act that we've mentioned before. And so the main thing that the PCAOB is concerned with is determining auditing standards and looking over the shoulder of those auditing firms to make sure they're doing what they need to be doing to ensure that the financial statements are accurate and have been checked correctly through their audits. Okay, so now we can move out of the letters for a bit into some real work. Is that you are providing useful information to those users. Okay, and part of being useful is that the information needs to be both relevant and it needs to be represented faithfully. Okay? Users of your financial statements need to make sure that they can have good information because they might be making decisions. Maybe they want to invest in your company. So you need to make sure that, again, it's useful, it's relevant, and it is faithfully represented. What we mean by that one is that you have all of the information necessary, that as far as the company knows that it's not a biased presentation, and it also is free from any material or free from any errors or misstatements, again, that they are aware of. Okay, so useful, relevant, faithfully represented. Some other qualifications or qualities that we want in our financial statements and information is that we can compare them. This is where we're talking about, like we mentioned with GAAP and IASB and the differences between that. we want to be able to compare your financial statements and someone else's, and that it makes sense to us. Because if you're using totally different rules than I am, then the value you have for your, say, building and the value I have for my building, I can't really compare those because the way we got to that number is totally different. So I need to be able to compare among different companies. Okay, I need to make sure that we're all using the same types of accounting principles and standards and rules and regulations. Consistent. We want to make sure that the same company is using those accounting principles the same way each year or each accounting cycle, period to period. If we decided to use, one method to count our inventory this year and then we use a totally different one next year, that's not consistent. It makes the numbers not as useful. So we need to make sure that you're consistent in using those different methods and accounting guidelines. Verifiable. That means that if an independent source came in, like auditors, and like we have auditors that come into companies and look over our information, that if you follow those same methods, you should get the same results, or pretty much the same results, as I do when I do them using those same methods. So we can verify. It's verifiable data. Timely. It's also good that the information we have is timely. Otherwise, it also can't be relevant. We talked about relevance before. So it has to be available to those users in a timely fashion. If you had financial statements that you prepared and you didn't give them out for 3 years, it's not very timely. Can't make good decisions on that because that time is far gone and I can't really rely on those, and a lot of things could have changed between now and then. So you have to provide information on a timely basis. Understandable. You need to present the information in a way in which it is understandable for your users, that it's clear, that it's not muddled and you have too much stuff there and it's not easy to understand. You want to make sure that it's very clear, that it's concise as much as possible. Again, that a reasonably informed user could interpret and understand that data. It doesn't mean that any person ever could pick it up and understand those financial statements, but someone that is reasonably informed could pick those up and easily see what they're looking at, understand it, and make decisions based on it. Right? Business or economic entity concept. That each company or each different type of economic entity can be separated and identified and accounted for. This is also referring to the fact that you don't mix personal and business transactions. If you were, say, a sole proprietor, you would not want to account for your personal things the same as you would your business. Okay, those need to be separated, separate things. Okay, you need to take care of just those business transactions. You don't want to mix the two together, personal and business. Don't mix those two. Going concern means or refers to the longevity of the business. And specifically, the going concern assumption is saying that as far as you know, the business will continue into the foreseeable future. You don't expect it to go out of business tomorrow. And that's what we refer to as the going concern assumption. A unit of measure or monetary unit concept or assumption is really talking about dollars. We record things in dollars, okay, in a monetary value. In the U.S., obviously, we are in dollars. And so we don't record things in hugs or in pencils or anything like that. We only record those things that can be quantified, and we record them in dollars. The cost concept. This is referring to recording things at cost. Now, there are two types of cost you can record. You can record things at historic cost or fair value. Most items are dictated by GAAP that we record them at historic cost. So if you purchased a building, the purchase price of that building would be the cost we recorded at. Okay, some things, however, are recorded at fair value, especially things that are actively traded, for instance, investment securities. Those would be recorded at their fair market value, whatever the market value is currently. So those could be adjusted up or down. Again, most things we record at historic cost because, again, we want to stick with that faithful representation, and that could be marred if we go with fair value for everything. So look at your text for some more details about when we would use historic and fair value, but for the most part, we will be using historical cost. Objectivity. You want to make sure that when you record things, they are recorded objectively, or you can say it at arm's length for transaction type of data. You want to make sure that this is something that you haven't given any subjective thought to, that this is objective. Again, it goes back to faithfully representing your transactions and your data that you're showing people. So objectivity is a big one that you want to make sure that you're sticking with. Time period. Okay, sometimes you may see this referred to as I can never say the word periodicity. Periodicity. Anyway, I refer to just time periods. You can divide up your accounting year into, or even the life of the business in general, into specific time periods. So whether that's monthly, quarterly, annually, you can provide data at intervals of time. Okay, that was a lot. It was a little varied, but those are some different topics, different things, different items that we need to be aware of and that influence how we do accounting, why we do accounting.